venture capital. I hear
Yeah.
about this world in podcasts mostly, but it's more of like a glossing over as a stage between like concept entity to like the mature business. So what is it like inside the world of like venture capital?
So venture capital or access to capital, or however you want to describe it, it's so diverse. And no, let me rephrase that. The experience that you could have can be very different from one person to another. So you could have a experience with one person where they're totally like a jerk and they are hard to deal with and there's a high level of arrogance. You could have another interaction with somebody who's filled with empathy and kindness and generosity. The overarching theme is everybody wants to invest money in order to get a positive return on investment. Every ecosystem has its own style of venture capital. So the venture capital scene in Pittsburgh is very, very different than the venture capital scene in New York City, which is also very different than the venture capital scene in San Francisco. So I could speak much better on New York and Pittsburgh because I've been in those two cities and I understand them. And I know about San Francisco, but I've never raised any personal capital or professional capital from there yet. But I would say the world of venture capital is a place where you have to find people that are kind of like-minded. And that means if your company is like an agricultural technology company, right? Like you have some special hydroponic growth for strawberries, you're going to want to find venture capitalists that invest in early stage agro tech companies. And it's cool because you'll get to find people that are passionate about what you're passionate about in the best of worlds. In other senses, it can be challenging because it's like you're constantly applying for a job when you're raising funds. Like you're constantly reaching out to people that have capital and you're trying to explain to them why your business will be more valuable tomorrow than it is today. And so there's goods and bads to it. Some people love raising funds, some people hate it. It's normally kind of challenging. But there's so many different ways that venture capitalists can interact. And there's also a lot of ways that you can raise funds that are very different as well.
Right on. Yeah, I've never had to obviously I haven't ventured into the world at all, but yeah, I just always hear that being brought into the conversation whenever they're talking about building a business, but it doesn't seem to be, nobody seems to go into it in very much detail. And I was just always very curious, and obviously having somebody in front of me right now that's like been in the world, I just had to ask.
Sure. So very simplistically, you're going to have an idea or a company or something in between, depending on what stage of capital you're going to raise. In the very, very inception, you have what's called seed capital, which seed capital is probably for most people less than $500,000 in investment. And that is where your like earliest stage investors come in. Often that seed round is friends, family, your rich uncle, Rick, or your rich aunt, Jamie, whoever you have money to get from. After that, you have your series seed round, series A, series B, series C, series D, and then, an initial public offering or taking a company public. Each round of capital is normally like about 3 times as big or bigger than the previous round. So if you raised a seed round of $500,000, you might raise a series A of $2 million. And every time you raise a round of capital, the value of your company typically goes up as a multiple as well. So if you had a company and it was worth $10 million today, and you got $5 million of investment, your company would then be worth $15 million post money. And for the $5 million, the investor would get 1/3 of your company because 5 over 15 is 33.33 repeating. And that's the very, very, very basics of venture capital, but there's so many nuances of voting rights and common stock, preferred stock, liquidation preferences. And like you and I could spend a 5-hour episode diving down this rabbit hole. But at the end of the day,
we can do that.
Yeah. Most investors, in my opinion, value one or two things, which is control and percentage of the company that they have. And those two can be the same or they can be different. So there are control provisions that we could draft up. If I invested $1 million in some good print, where I might have the ability to veto certain sales of the company. I might be on your board of directors and I might have some sort of, provisional control votes that, I make certain decisions. I might be able to, a liquidation preference for somebody who doesn't understand that would mean I might put a provision in that I get twice my money back before any other investor gets any money. And there's like 1,000 things that you can go down this. But as a founder, you might care a lot about control. So you might give up 70% of your company, but you might install a 10x voting right. So even though from a financial perspective, you only own 30%, from a control perspective, you might be able to still control the company. And so kind of going down that rabbit hole, there are an insane amount of things that could be variables in this. And what you want to realize is anybody who comes on board as an investor is really a lifelong partner in your organization. And you need to get along with them. You need to share a vision as well. And when I went back to like someone who invests in agri-tech in my previous example, I would say the same thing is true for when you expect to return your money and how much money you expect to return to them. So again, if I invested $1 million in some good print, if your plan is to get to a place to generate $10 million a year in profit, and I'll own a third of the company, in a best case scenario, you're going to pay me $3 million a year from now until when you shut the business down. That's one level of expectation. I might expect my first profitable check to come into me in 2 years. Alternatively, you might say, Josh, our goal is to make it really, really big and to get to $1 billion valuation and do an initial public offering, which on the New York stock market. And in that scenario, we want to be like Canva, which is just this huge company, but you have to realize that your investment at this early stage will not be paid back for 5 to 10 years. And as an investor and as an entrepreneur, you should be upfront with what your expectations are, because the last thing you want to do is have me wanting to get money back in 6 months and your expectation is it's going to be 7 years, where neither of us are going to be happy in that scenario.